For today, I am delighted to meet the legendary economist and investment strategist of Wall Street, Ed Yardeni, join us today. Mr. Yardeni, it's great to have you with us.
Thank you very much.
Firstly, I would ask, how do you evaluate the US's inflation? CPI rose 7.9% in February. What does this number mean to US economy and market?
Well, we had a tremendous amount of fiscal and monetary stimulus as a result of the pandemic, and it did a very good job of reviving our economy. But it was too much, and as we saw in 2021, we started to see a real big pickup in the inflation rate. And in March, it went over 2%, which is the Fed's target. And now, as you said, it's 7.9% in February. I think that the outlook is that it will remain high and probably won't peak until maybe the summer, now that the Ukrainian war has led to still higher food and energy prices. So for the Fed, this means that there's a bigger inflation problem, and that they have to move ahead, notwithstanding the uncertainties caused by the war in Ukraine. But I think they have to move ahead at the March 15-16 meeting and start raising the federal funds rate.
And recently, you have mentioned that US economy is already in a stagflation. Could you tell us the details you have diagnosed?
Sure. Well, what I really have in mind is that before the war in Ukraine occurred, starting on February 24th, before then, the outlook was that inflation would probably peak within the next few months, maybe in the spring, around March or April, and it would peak perhaps on a CPI basis around 7 to 8%, and that then it would moderate as some of the issues that were related to the pandemic, some of the supply chain disruptions were fixed. And so the outlook was that inflation would start to come down and that the economy would continue to grow at a fairly good pace. We have a very strong labor market, for example. Now, because of the war, because of the shock impact that's had on food prices and energy prices, I think we're looking at a stagflationary outlook, which simply means that we're going to have higher inflation and as a result, lower economic growth over the rest of the year.
And if we are already in the stagflation in especially food and energy service like that, what will be a turning point to get back to normal economy?
Well, it'd be nice to get back to normal. Things haven't been normal for a while, obviously with the pandemic. And just as the pandemic seems to have improved significantly, we are seeing this war and creating some real shocks to not just commodity prices, but to supply chains once again. And so I think that we're not going to get back to 2% inflation for a while. The problem we have is that while some inflationary pressures are moderating, for example, we should see a slower pace of increase in the prices of some consumer durable goods like automobiles, like furniture and appliances. However, even if these areas of the CPI moderate, we are likely to see the rent inflation picking up, because one of the impacts of the pandemic was to create a significant demand for homes, and home prices have gone up at a double-digit rate of 33% over the past 2 years. And as a result of that, a lot of people who wanted to buy houses can't afford them and are being forced to continue to rent. So rent inflation is going to be really a troublesome category of the CPI in over the next year or so. So if we're very lucky, I think we might get inflation back down to 3 to 4% by the end of this year or sometime early next year. But I don't think we're going to see 2% anytime soon. Meanwhile, the growth rate of the economy, I think, should continue. I don't see a recession. It's a bigger risk now as a result of the Ukraine war. But I think we're looking at 2.5% growth in real GDP this year and next year.
If we have the risk like that, and then in the investing strategic point of view, do you think that hiking gold price is entering a long-term uptrend?
Well, there's a discussion, there's a debate about the long-term outlook for inflation. There is one thing we know for sure that we can agree on, is that there is a very significant shortage of labor in the United States. And by the way, there's a shortage of labor in many countries around the world because of demographic developments. We have aging populations where the older people are retiring. And because fertility rates were so low for so long, we're not seeing that these people are being replaced by more than a one-to-one basis. So the growth rate in the labor force in the United States is going to be pretty close to zero. And the same thing goes for a lot of other countries. As a result of that, that could lead to a more persistent and troublesome inflation situation where inflation continues to move higher. I think that businesses are going to respond to the labor shortages by dramatically increasing their spending on capital equipment and on technologies to increase productivity. So I'm still actually optimistic that we will see a productivity boom in the 2020s. Doesn't feel that optimistic right now, I realize, but I do think that in some ways, like the 1920s, the 2020s could be a period of tremendous technological innovation, boosting productivity and increasing standards of living.
Thank you for your answer. And let me ask you again about the stagflation and Fed's role. Then how should the Fed actually cope with the situation?
Well, the Federal Reserve is very much behind the inflation curve. Inflation on a CPI basis right now, February was 7.9%, and the Fed funds rate is zero. And it's at this March meeting, March 15th, 16th, that they will raise the Fed funds rate. And the big debate is whether they will do just a quarter point, 25 basis points, or they will do a full half point, 50 basis points. And I think given the high inflation numbers, they should be more aggressive. However, the Ukraine war does create a lot of uncertainties. It's led to higher oil prices, higher food prices, supply chain disruptions again. And that does increase the risk of a recession, which the Fed does really not want to see happen, doesn't want to see the unemployment rate going back up again. So they've got themselves a real significant problem. I think this Fed is likely to be very cautious and gradual. So I'm looking for 25 basis points this meeting, and I think they will probably raise the federal funds rate from 0 to 1% by the end of the year. So 4 rate hikes. I don't see 6, 7, 8 rate hikes the way that some other economists are forecasting.
So your view is kind of the Fed will take some gradual steps. Then let me think about it. What if the situation getting worse? Which would be an option the Fed likely choose between taking risk of inflation and taking risk of recession of asset markets?
Well, given what I know about the Fed right now, I think they're more likely to be gradual, which means that they're more likely to tolerate inflation staying higher for longer. as long as they have an excuse. And clearly the events in Ukraine provide them with an excuse, an appropriate excuse really, to say that it's created a tremendous amount of uncertainty for the global economy and also for the US economy. And a gradual approach is best. If that's the case, then they will tolerate inflation much more so than Paul Volcker did in the late 1970s. Before Paul Volcker, in the 1970s, we had a couple of Fed chairs that tolerated inflation and let it go higher. And I'm not convinced that this Fed is going to do what Paul Volcker did, which was to let interest rates go to whatever levels were necessary to bring down inflation. And of course, the only way that the Fed can really bring down inflation is with a recession.
Thank you for your insight. And let's move on to another question. How do you see the US stock market trend in this year?
Well, I thought that the market might continue to go sideways with a lot of volatility. So the S&P 500 was at 4,800 at the beginning of the year, roughly 4790 thereabouts. So it was 4,800 at the beginning of the year. I thought before the war in Ukraine that it would be volatile and we would probably go sideways to end the year at 4,800 with a lot of volatility. Now I think that because of the war, inflation is going to be higher, economic growth is going to be slower, and I think that the earnings outlook doesn't really change that much because higher prices will offset some slower growth. What really changes is how much investors are likely to be willing to pay for earnings with a kind of volatility and uncertainty. So I did lower my expectations to 4,000 by the end of the year for the S&P 500 just this week. And that's a 16% decline from its all-time record high, which is really still more in the nature of a correction than an outright bear market. And then next year, I think things will get better. And I do look for 5,000, a record high of 5,000 in the S&P 500 in 2023.
Thank you, thank you. And after the pandemic, the number of Koreans investing in US stocks has increased significantly.
Yes.
Could you advise on a portfolio or strategy of the US stock market?
Well, I suspect that Korean investors have been particularly investing in U.S. technology, in the U.S. technology sector. Yeah, the U.S. Stock market has much more market capitalization. It has many more technology companies than other countries do around the world. Obviously, Korea has a lot of great companies overall and in the technology sector. But investors typically do like to diversify on a global basis, and the U.S. has clearly been very attractive and provided some very good returns. I would say that investors should stay in the U.S. stock market, recognizing that it's going to be volatile and they're probably not going to be making money this year. This is the year that they should be looking for opportunities to buy cheaper U.S. stocks in the technology sector. But I also like energy, and there's a lot of energy companies in the U.S. that are still relatively cheap, and financials. So energy is a good hedge against inflation. Financials, the banks, the investment bankers are good hedges against rising interest rates. And technology is a good way to invest in a future where labor shortages need to be offset by technological innovations that increase productivity.
Thank you. Actually, many Korean investors having investments in technology stocks in US markets. So I have to ask again, how about the big tech, which falls deep in earlier this year. Do you think the Biden strategy still works for this year?
Well, I think that this year is not going to be what is sometimes called a momentum market, where the momentum just continues to drive stocks higher, particularly certain stocks like technology and some of the bigger stocks, which is what we've seen over the past few years. The pandemic clearly was a big boost to the biggest 8 companies in the S&P 500, and they all basically tend to be technology names. I mean, they're not necessarily in the technology sector. As for example, Amazon is actually considered to be a consumer discretionary stock, but we all know that it's makes a lot of money in cloud computing, so it is a technology name. I think you're going to have to be more of a stock picker this year and look for opportunities. So to the extent that an investor has been involved in the US market and has some familiarity with which stocks they want to own, this would be an opportunity to buy some of these stocks cheaper. But keep in mind that the main problem in the US stock market is not economic growth. It's not even inflation. It's not earnings. The main problem is valuation. Over the past few years, the valuation multiples that people were willing to pay for stocks simply got too high. And they were paying 20 to 30 times earnings, the outlook for earnings. And that doesn't provide you a lot of cushion, a lot of safety when things get a little bit unpredictable, uncertain, and especially in an inflationary environment with a major geopolitical crisis. So I wouldn't necessarily just kind of buy all the stocks that worked over the past couple of years. I'd be more selective. But certainly semiconductors, cloud computing, those areas are going to continue to do very, very well. I know that there's been quite a bit of investing in the ARK funds, and the ARK funds, the concept is a very good concept. And I know Kathy Woods, and she's a very bright lady, but she's investing in an area that is prone to a lot of volatility. And some of the companies really have very high valuation multiples, and that's a problem. And she's recently described her funds as a venture, sort of a way for retail investors, for individual investors to invest in technology, in new technologies. And she kind of called it a venture fund. And I think that's the way you have to look at it. Venture funds can some of these stocks are going to work and some of them are going to fail. And so you really have to have a long-term outlook, and you definitely don't want to make that to put too much into that kind of volatile area of the marketplace. But I think it does offer an attractive way to invest in the future, but you have to understand the kind of risk you're taking.
Thank you. I'll keep that in mind too. Let's move to another one. Since this year is the year of the midterm elections, there are many views that the US stock market will rise in the second half of the year, like Tom Lee or someone else. I wonder if you have same point of view or not.
I think it makes sense. It's a reasonable view. There's the stock market does have a tendency to do better after midterm elections. The problem with looking at history and expecting history to repeat itself is, as the saying goes, history doesn't always repeat itself, but it does rhyme. So sometimes there are similarities, but sometimes there are important differences. I would say that it's reasonable to expect that the market should do better after the midterms. presumably the geopolitical crisis that is hanging over the market will be behind us by then, hopefully with a outcome that's better for the global for globalization. That's better for the outlook for inflation. But I think the U.S. economy is a very powerful economy, highly diversified, a lot of different industries, and with a very strong consumer, a very big in IT sector, healthcare, finance. So I think the future is actually pretty bright, and I think the U.S. economy, as well as your economy, are going to participate in a better future.
Thank you. And now let's check about some scenarios related with the Russian Federation. There's some uncertainties we face. What will be the impact on the US and global stock market if Russia declares moratorium or default? And do you have some possibility to do that?
Well,
I mean, do you believe
it's an extremely unpredictable situation because it really depends on one person, and that is Russian President Vladimir Putin. He's in charge, and there's some questions about his mental state. There's some people looking at pictures of him sitting at the end of one very, very long table, talking to people at the very other end, suggesting that he reacted very badly to the pandemic, that he's maybe germophobic, and nobody really knows. And there's some, there's for him to raise the issue of nuclear weapons, it just sounds absolutely crazy. But craziness can be a strategic or at least a tactical approach to running a war. If you can convince the people you're fighting that you're totally unpredictable and you can do something crazy, I mean, that's clearly the reason that the West, particularly the United States, is not intervening directly in Ukraine. But on the other hand, while the West is not sending troops into the Ukraine, they have started a remarkably strong economic war against Russia, and their economy is collapsing. And the only question is whether Putin, who isn't going to suffer very much since he's very comfortable where he is, will respond to the economic war by backing off the military war. But I think he's miscalculated. I think he made a lot of very bad judgments about how quickly this would occur and how little damage would occur to Russia, and how easily it would be to overcome resistance in the Ukraine. But instead, he's united NATO and he's united the Ukrainians against Russia. And so it's hard to predict how long this thing lasts. But I think behind the scenes, there are countries like China and Turkey and Israel that are trying to mediate to come up with a solution that all sides can accept. And there's some talk that President Zelensky, who's turned out to be quite a hero in the Ukraine, might be willing to offer the concession that Ukraine won't join NATO and will become more neutral. Everybody keeps talking about the possibility of kind of having Ukraine become sort of like Finland. And so there's a solution here. There's as there always is, a negotiated solution is still possible. It really just depends on how Putin responds, because the other way he could respond is because of the setbacks, he could launch even more missiles and artillery against Ukraine. But I think one way or the other, this is not going to last much longer. I think there will be a ceasefire and a negotiated settlement by the summer. And then there'll be the issue of how to rebuild Ukraine and how to create a more secure global system. You know, there's been a lot of, there's been a Cold War between the United States and China developing. And so how do we resolve some of the issues between the West and China? And hopefully there will be some positive outcomes of this terrible war in a more secure geopolitical environment where countries don't attack other countries, invade other countries, and work things out in a more peaceful way, so that globalization doesn't suffer. Because globalization is a positive for us all. It does keep inflation down. It does provide better goods and services for everybody. But we really need to have another. We do need to look at the world order and make sure that it's more secure for everybody.
Thank you. And will be last question. After Russian stock market get removed by MSCI Emerging Market Index, and how does it would move to emerging market like KOSPI, that means Korean stock market, and or any other stock market in Asia?
Well, I think what we've just seen happen to Russia is an extremely unprecedented and unique event, and it might not happen again because the world, not just the West, but the world, over 140 countries in the General Assembly denounced what the Russians have been doing in the Ukraine. And the Russian economy has been shut down. The MSCI has removed Russia from its indexes. Companies are leaving Russia. So Russia has become a pariah state, a pariah country, a pariah economy, isolated almost completely. And I think even the Chinese government is having some second thoughts, concerns about having supported Putin in a meeting between President Putin and President Xi before the Olympics. I think clearly they view that, must view it as a foreign policy mistake. So Russia has been completely isolated, almost completely isolated, to the extent that I don't think any other country will do what Russia has done, recognizing the extent to which the world can isolate a country as big as Russia, and create an example that other countries will not want to copy.
Thank you. That's all for today's interview. I really appreciate sharing your insight. Thank you, Mr. Danny.